Hello, Evelyn. Esther is my name, and I will be taking us through managerial accounting discussion at introduction level. Thank you. Now, managerial accounting is sometimes referred to as management accounting and is defined as the process of providing information, financial and relevant information to managers for decision-making purposes. Now we are going to mention the three major uses of financial accounting. One, financial accounting helps managers make decisions. Take, for instance, which product to bring to the market and how much to charge for it. Should it be done inside or outside? Second, the managerial accounting is used for planning for the future of the company. Should we invest in this product or not? Things like that. Managerial accounting, thirdly, is used for monitoring actual results versus planned results of a company. Say, profitability now and what was targeted. Now, it is important for us to mention the three different books relevant to for managerial accounting. And these are the financial books, the management books, and the tax books. The financial books are used to report the financial position of the company to the outside audience, e.g., the shareholders of a company, the creditors of a company. Management books, these are budgets and product profitability reports that managers use for decision making. Then tax books are for filing returns to tax authorities annually. And in Uganda, we have Uganda Revenue Authority as the tax authority. Now, it is important for us to emphasize the difference between managerial and financial accounting. Financial accounting, one, is used for external audience. It has a set of standards it follows, and it uses past information, all historical information, versus managerial accounting, which is used for internal purposes, which does not have a set of standards to follow, and it could be used for an individual purpose. That means information gathered for one decision may not be relevant for another decision. Now that we know those, let us look at managerial accounting in terms of costs and decision making. Now, we shall introduce the term different costs for different purposes. And a cost can be traced back to a cost objective, which could be the customer, the product, or a department of the organizations. And these can be categorized as follows: direct or indirect costs, one; product or manufacturing costs. Then the opposite is non-manufacturing or period costs. Then we have the variable costs versus the fixed costs. Direct costs can be directly traced to a cost product. For example, the cost of raw material used for a loaf of bread. Indirect costs are not easily traced back to a cost product. Let me say the electricity bill used to manufacture a loaf of bread. Then product or manufacturing costs. This could be the direct, the indirect costs, and the raw material. Then the period costs. These are generally the administrative costs that a company incurs. Now, let us emphasize that manufacturing costs are recorded as they are made on the balance sheet, and then they are recorded on the income statement as the cost of goods sold as they are sold, versus the period costs, which are recorded as expenses on the income statement. Then variable costs, they change with the level of activity. For example, increased production of bread will lead to increased cost of material of a company. So now this will take us to cost behavior, and here we are going to mention the 4 patterns of cost behavior. which are much related as above. Let's say the variable costs, which vary with the level of activity, as we have mentioned above. The fixed costs, which remain constant, whether there is activity going on or no activity going on. Take for instance, if you choose to lay back and not bake bread, you'll still pay the rent of 500,000 as when you made $10,000 of bread. Then mixed or semi-variable costs. This can be affected by the change of level in activity. Take for instance, you will pay power bills if the level of activity is too high. However, even when it is zero, you will still pay some sort of electricity bill. Maybe the lighting, which is not related to the bakery machines. Then the fourth is the cost steps, and these are costs which are fixed at a certain level of activities. Say, on a certain level of production, at a different level of production, and then another level of production. They will be fixed for that particular level, basing on the situation. I would like to emphasize that they are curves related to cost behavior. Because of time, we can't mention them, so we should look for them. Thanks to Professor Leach of Coursera, to my teacher, to my lecturer, Mr. Mashanti, and my classmates.